Here's a summary of Rio Tinto's Rio 2025 Q4 earnings call, presented in a clear and concise manner suitable for reading aloud. Rio 2025 Q4 earnings call summary. Good morning and welcome, everyone. Today, we'll be reviewing Rio Tinto's full year 2025 results. CEO's opening remarks. Our CEO, Simon, began by emphasizing safety, noting a tragic fatality at the Simandou mine in Guinea. He stated that all site works and construction activities have been halted, and an independent investigation is underway, supported by a new safety advisory panel. This underscores Rio Tinto's commitment to learning and improving safety practices globally. Turning to the financial results, Simon highlighted significant progress towards their mission of being the world's most valued metals and mining business. This is being achieved through a stronger, sharper, and simpler way of working, driving productivity and cost reduction. Key financial highlights and performance. Operational performance. 2025 saw strong operational performance, with an industry-leading 8% increase in copper equivalent production, setting annual records for both copper and bauxite. The Pilbara mines recovered well from earlier cyclones, achieving record production from April. Importantly, copper equivalent unit costs reduced by 5%. Diversification value. The benefits of diversification were evident, with underlying EBITDA increasing by 9% to $25.4 billion. Copper and aluminum were particular highlights. Self-help and productivity. Rio Tinto unlocked $650 million in annualized productivity benefits. Shareholder returns. Stable underlying earnings of $10.9 billion led to a shareholder return of 60%, equating to $6.5 billion in dividends. Future outlook and strategy. Simon expressed confidence in Rio Tinto's positioning for future growth, with strong prospects in aluminum, lithium, and copper, alongside resilient steel demand. Supply constraints globally and lower sector capital expenditure create opportunities. The company is on track to deliver a 3% CAGR for copper equivalent production through the end of the decade, driven by operational excellence. The $650 million productivity run rate will be achieved by the end of Q1 2026, with further cash improvements expected in 2026. Key growth projects advancing include Oyu Tolgoi. Underground development is complete, with ramp-up on track to deliver an average of 500,000 tons of copper per year between 2028 and 2036. Simandou. The first high-quality iron ore shipment was achieved, with a target of 60 million tons per annum upon full ramp-up. Lithium. In-flight projects are progressing towards a targeted capacity of 200,000 tons per annum by 2028. Rio Tinto is also focusing its exploration efforts, directing 85% of its budget towards copper. Capital discipline and portfolio management. Rigorous capital allocation remains paramount, with all projects needing to demonstrate shareholder value. The company is actively testing the market for its RTIT and Boritz businesses, aiming for $5 billion to $10 billion in cash proceeds from asset sales. Regarding the discussions with Glencore, Simon stated that while constructive, an agreement that would deliver value for Rio Tinto shareholders could not be reached. The focus remains on their disciplined approach to M&A and their current strategic plans. CFO's financial review. Peter Cunningham provided a detailed financial overview, reinforcing the themes of volume growth, cost reduction, and capital release outlined at their Capital Markets Day. Volume improvement. A significant $3 billion year-on-year volume improvement was driven by operational excellence and higher copper volumes from Oyu Tolgoi. Cost discipline. Substantial cost reductions were delivered in late 2025, which will flow into 2026 results, further enhanced by systemic improvements. Balance sheet. Net debt increased to $14.4 billion due to the Arcadium acquisition, but the balance sheet remains strong with 18% gearing. Future capital release initiatives will further strengthen the position. Dividend policy. The company reiterated its commitment to returning 60% of underlying earnings to shareholders, having maintained this payout for 10 years. Market overview. Iron ore remains supported by Chinese steel export growth and a structurally balanced market. Copper and aluminum. Prices rose by 9%, with copper ending the year 44% higher and aluminum 17% higher than 12 months prior. The energy transition is a key driver of demand growth, particularly in power systems and electrification. Lithium. Momentum is strong, with markets rebalancing earlier than expected. Battery storage demand is a fast-growing pillar of the energy transition. Product group performance. Iron ore delivered $15.2 billion of EBITDA with unit costs in line with guidance at $23.50 per ton. Guidance for 2026 is $23.50 to $25 per ton, reflecting the impact of a stronger Australian dollar. Copper, a standout performer, with EBITDA more than doubling to $7.4 billion, driven by higher prices and rising volumes. Unit costs were down 53%. 2026 guidance is comparable to 2025. Aluminum showed stability, with a new production record for bauxite. EBITDA was up 20% due to stronger markets. Lithium. The new business is not yet a significant contributor, but is focused on delivering in-flight projects to reach 200,000 tons by 2028. Capital expenditure. 2025 CapEx was at the high end of guidance at around $11 billion, reflecting peak spend on growth projects like Simandou, $1.6 billion, and lithium, $1 billion. Guidance for the next 2 years remains at up to $11 billion, before stepping down to $10 billion thereafter, as growth commitments ease and Simandou nears completion. Key takeaways from Q&A. Glencore discussions. The focus was on value creation, and while discussions were constructive, a deal could not be reached that delivered incremental value for Rio Tinto shareholders. The comprehensive review encompassed all assets, including coal. Cost-cutting. The $650 million productivity run rate will be achieved by Q1 2026, with 2026 cash delivery expected to be materially above this. This is a multi-year program across all businesses, with further benefits expected in 2027 and 2028. Iron ore strategy. Rio Tinto has enhanced options with IOC, Pilbara, and Simandou, allowing them to offer high, mid, and low-grade iron ore to the market and collaborate with customers on their forward needs. Simandou safety. While acknowledging the recent fatality, the company is confident in achieving the 60 million tons per annum target, emphasizing the need to adjust operating practices to the jurisdiction. Lithium. Outlook. The company maintains a long-term view on lithium prices, considering decades of operation, and is focused on current projects while exploring future options. Copper growth. Rio Tinto has a robust pipeline of copper projects, including Resolution and Nuevo Cabra, and sees significant partnership opportunities, particularly with Codelco in Chile. Geopolitical risk. The company acknowledges geopolitical risk and applies rigorous evaluation, including higher discount rates for more challenging jurisdictions, but ultimately prioritizes value and cash accretion for shareholders. Dividend policy. The company is comfortable with its 40% to 60% underlying earnings payout range, noting that performance has consistently supported the upper end. Asset disposals. The process for RTIT and Boritz will be patient, with no pressure to sell, seeking value that reflects the long-term potential of the assets. In conclusion, Rio Tinto delivered a solid year of operational and financial performance in 2025, underpinned by its stronger, sharper, simpler strategy. The company is well positioned for future growth, with a strong focus on copper and a disciplined approach to capital allocation, ensuring value creation for shareholders. Thank you.